Thank you, Simmi. Thank you, Abhishek. Thank you, Jayant, for joining us today. Thanks a lot. It's great to be here. Great to have this conversation. This is the right time for this conversation, I believe, and glad that you all have are here to listen to these expert speakers talk about debt finance for climate. Can we have each of the speakers do a quick round of introduction, and then we can jump into the specific aspects of it.
Sure. Thanks, Ravi, for having us. I'll go first. So I'm Simmi Sareen. I run the debt practice at Unitus Capital, which is a boutique investment bank focused on impact. I largely lead the climate transactions there. I also run Climake, which is a platform I set up a few years ago to help early stage climate tech startups get access to both debt and equity capital. We also focus on climate research and direct asset funding for climate assets at Climake.
Thank you, Simmi. Over to you, Jayant.
Thanks, Simmi. Thanks, Ravi. I'm Jayant. I founded cKers Finance. We are an NBFC which is focused on sustainability and clean energy financing. We funded across solar energy efficiency, rural energy access, and electric vehicles. Currently, a lot more action is happening in EVs than in many of the other segments. And as I mentioned earlier, we primarily focus on cash flow backed debt. So happy to contribute in whatever way I can in this session.
Thanks, Jayant. Over to you, Abhishek.
Hi, my name is Abhishek Fogla, and I'm an investment banker. I've raised about slightly more than 5,000 crores of capital for 100 plus companies across 250 plus transactions in the last 15 years. I run my own investment bank called Accela Fiduciar, which is largely into debt investment banking, and work across the social impact space. Of course, climate tech is a focus area for us. So,
fantastic. Thank you so much for the quick introduction to each of the speakers. Here is the big question, right? India wants to be net zero by 2070. It's a big and ambitious goal that was stated a few months ago by the government, right? And I understand that we will need about $100 billion of finance every year to achieve this target. Now, where does this money come from? And where is it? What kind of role debt has to play in this particular space? I'll start with Simmi.
Sure. So I see that you picked the 100 billion number we recently talked about in our report, Ravi. And that is a big number, right? Especially given that today climate investments are about 22 billion, last year. The thing is that climate is different from everything else we've seen in the past, right? When we look at tech or SaaS or everything else that VCs and Ps are focused on, those are businesses that need a lot of risk capital and very fast growth capital, which climate does as well, because climate has to fund innovation. But climate is different because climate businesses also need assets. They need working capital because these are projects which have long lead cycles. These are projects which are B2B and need to put actual physical assets on the ground, which is why we feel that climate investments will need to be a mix of many capital structures, not just equity. So equity is important because equity funds innovation. Equity funds burn or early capital as companies grow. But as they start to scale, or even before that, when they have to deploy working capital, or when they have to build more solar plants or put more EV fleets on the ground, these are areas where you can actually see how much your assets are generating, which means that you can also fund it with debt, not just equity, which is a far more costly form of capital.
Thank you, Simmi.
Thanks. So if I may take a stab at it, there are two or three things when we look at climate finance. Part of it is energy generation infra creation, which is something which people understand. And the road to 2070 is built through the road to 2030. So there is a phenomenal amount of deployment which needs to happen in energy generation infra over the next 7 to 8 years. The balance of it is built on energy efficient or carbon neutral assets or new business models which are coming up in terms of circularity and innovations around that, right? Now, the way I look at it from a financing conundrum perspective and why cKers got started as a debt financier in this space is whenever something new comes in terms of a new technology or a new business model, there is experimentation. And that's the job of grant capital, soft capital, equity capital, R&D spending to fund that discovery of that new technology, adaptation of that new technology, and proving the new business model, right? But beyond that, it's all about putting assets on ground, as Simmi had colored. And that's where we felt that anytime something is new in terms of technology or business model, not just the Indian financing system, but any financing system drags its feet on funding it because the risks are not discovered and things are not known. And at that same point of time, people who are pushing those technologies or business model feel that, hey, this is almost solved or all solved. And why are people not coming in and funding it? There's no risk there. And that convergence happens every time you have either infra assets or non-infra assets coming in. And that's where it's important for the initial financiers in the ecosystem who take the lead in funding this to create it from a market maker lens, right? So you're discovering models on how to fund something. You're trying to get other lenders to fund it. And you're hopefully trying to avoid the issue where debt is getting confused for equity, because that confusion leads to a self-fulfilling situation where, because the risks are more, the rewards are less. Eventually, the other debt lenders sort of get scared and move away, saying, hey, this is still too early stage. So at a very high level, where the capital is going to come from, we are really adding what the country needed to add anyway in terms of energy generation assets. Just the nature and form is different. We are really adding what the country needed to add anyway in terms of vehicles when we move from IC engine vehicles to electric, right? All it is that the conventional financing ecosystem is not very convinced for a period of time which exceeds what people consider comfortable given their deploy cycle or given the unit economics, right? They don't come in with large amounts of money very quickly, and when they come in, they will typically crowd around to large utility scale or government-backed projects, right? Rather than going out to distributed solutions picked up by corporates, SMEs, individuals, farmers. And that's where the challenge and the fun both are in terms of creating pathways for debt to those. So I'm pausing there, and I'm sure we'll color more of this during this discussion, but I'm just pausing there.
Absolutely. Thank you so much, Jen. Abhishek, do you want to take a stab at that one?
Sure. So I've always advised the clients that I have that you should raise minimal equity, because equity, as Simmi rightly said, is the most expensive form of capital available. You should try to fund a business by debt as long as you can service it, and as long as you're not using the debt for risky activities like marketing or team expansion. Rather, I find it very strange when people fund working capital or capital expenditure out of equity alone, because that to me does not generate optimal returns. So if I just break it up, the debt component is even cheaper because you get a tax break on it. So your actual cost of debt is not the coupon or the IRR that you pay on your loan. It's actually that into one minus the tax rate, because ultimately, even if you're making losses, you're accumulating them so that you can set it off against tax benefits in the future. So that is there. The second point is, so that was a distinction between equity and debt. The second point is between B2B.
Abhishek, we are losing you a bit.
B2C.
Abhishek? Abhishek?
I think his internet froze.
His internet froze, yeah. So what I would like to just touch upon, because until Abhishek comes back, is that both of you have clearly identified that debt is a key player in this transition process, right? And Jayant, you did talk about clean transportation and clean energy being at the center of it and the infrastructure that it needs to be built, right? But here is a question. While clean energy has always attracted capital, whether it is debt or equity across the globe. And increasingly, the attention is towards clean energy because of the nature of the scale that it affords. And like you said, significant amounts of capital can be deployed immediately for these infrastructure projects, right? And that usually gathers a lot of steam. And clean transportation has picked up in the recent times in terms of its attractiveness, its glamour centered around it. But there are so many other climate tech, companies that are working towards a lot of other solutions, which bring about, maybe from an impact perspective, much higher value in terms of carbon reduction, right? I'm not the expert here, but have you seen anything like that, amongst the ones that you have recently funded, or globally? Are you seeing a transition where they're saying, okay, we understand clean energy requires money, but there are so many other elements of this, maybe agri, maybe construction, maybe heating. All of these probably will require equal amounts of funding required to reduce the impact, right? Have you seen this transition happening? Have you seen debt being attracted by non-conventional streams?
Sorry, Simmi, do you want to take a start at that?
No, I was just going to make a point to start off saying that it looks like clean energy attracts capital today, Ravi. But when we started doing climate, and Jayant, you probably remember those times 12 years ago, clean energy did not attract capital, right? So in some sense, solar has created the playbook for what transition from a new nascent sector to something mature that attracts a significant amount of capital looks like, right? And I think that kind of sets the framework in some sense, because a lot of sectors do follow that path. EV is following that path in a potentially a better and faster way than solar is. But the playbook is really that when you start off, there are very few lenders who are willing to take the risk. You need early stage risk-taking entities. So there's equity, and then there are folks who are doing the good work like Jayant is at cKers to say, this is a new sector, we can fund it, we can take a little amount of risk. There's also blended finance, there are guarantees that are coming to support this. But the basic thesis remains the same, right? For debt to work, debt providers need to get their money back with interest. Equity funders are taking the risk where they're saying, yes, out of the 10 investments I make, 2 will become multi-baggers, maybe 5 will die off. But debt guys need to make their money back every single time, hopefully, which means that for debt to start off in a sector, the economics of that asset or that business need to make sense from a cash flow perspective. Once that does, it's really a function of who can fund or who can take that early stage risk. And some people do that, establish a track record for the sector. And then as it grows bigger players come in, right? We've seen that in solar, we're seeing that at a much faster pace in EV. And I think EV got one thing right that solar did not get right early on, which was that while large companies get funded quickly, smaller assets find it difficult to get funded. And in EV, we are seeing that there are multiple options emerging for asset financing, for financing the fleets or charging or battery, even at early stage. Driven by the fact that these companies have raised large equity and they can provide comfort to the lenders that even if the business model doesn't work today, there's an equity backup available. And over time, the business model will start to work. But examples beyond that, right? So at Climake, for example, when we do direct asset funding, we focus on edge sectors, as we call them. And we have done things like on-farm assets, right? So solar dehydration, solar cold storage. We are looking quite seriously at circularity and waste management. That, in fact, is going to be a large sector, given that there's a lot of government focus on both fresh waste and biomining, as it's called, the landfill clearance projects. And we have funded some of those assets. And then, new sectors keep emerging, although in small volumes, right? But air and water and all of those would eventually emerge as significant sectors. But you would need early risk takers like Jayant to fund those. So Jayant, over to you for your thoughts on this.
Thanks, Simmi. Often, once you finish, there's very little left to say, but I'll just take a stab at it. So I'm just going to head back, Ravi, to 2 points. One I had said earlier, I had drawn an equivalence of areas where there is an equivalent being created, right? Power generation, vehicle. And what I had said is there are both solutions today and deployment today. And therefore, it's a question of bridging the lenders, debt providers to move from one to the other, one power generation asset to the other power generation asset, one vehicle to other. And as you rightly pointed out, and there are gaps there, and I'll color that in a sec. But as you rightly pointed out, there is a whole set of things which are new models, right? Somebody is trying to convert waste to oil. Somebody is trying to do biomining, etc. And whenever you get to new models, the challenge is two levels of bridge, right? You have a technology readiness assessment, which can be there can be a gap between what the innovator or deployer feels compared to what the market uptake is or what the financier feels. Then there is a commercialization gap. So you have to bridge through those gaps before you get to say that, hey, is it an asset which can be deployed or funded in asset finance or project finance mode? Or is it really a delivery service where it makes sense to fund the delivery service in the way delivery services are funded, right? So what is it and how do you get to fund it, and what's the parallel financing ecosystem for it, which you can attract towards it? Has these two gaps, right? So when we've been working with people in the ecosystem, we have been trying to see if there are facilities which help people cross TRL bridges, people cross CRL bridges, and then does it become asset, right? And now let me tell or color the gaps in the first model, where we are saying there is equivalence, and then also come back to the significant additional gap in the second model when we try and get mainstream debt to come into it. So in the first model, the gap is that we think solar is successful, but solar is still deploying 1/5 probably of what it can in terms of distributed assets, right? Most of the deployment pace and success has been in utility. We have very recent models raising money to deploy distributed assets and starting to scale up. But the potential is actually 5x or 10x today in terms of technology, economic viability. Sorry, Ravi, you're on mute, so I'm not sure if you're chiming in there, but so potential is 5 to 10. Yeah, potential is 5 to 10x. And therefore, it's not that, the playbook is something which has moved to the volume which is needed, not just by the net zero ambitions or the climate emergency, but by simple economics, right? Similarly, on EV, we're probably 5 years behind in terms of asset deployment compared to where we could have been, given when EVs became economically viable globally, right? So we took our time in terms of bringing them in, working through the technology challenges. Even now, what is getting deployed at scale is things like electric rickshaws and mid-speed or low-speed two-wheelers. And recently, we started deploying high-speed two-wheelers at scale. We're deploying cargo vehicles at meaningful volumes. So it's not that it's across the spectrum where suddenly everyone's deploying EV, right? So the gap here is, how do you escape the clutch of government auction demand? Whether it is senior debt, whether it is banking system debt, whether it's the bond market, whether it is pension money coming out of, everyone wants to chase the gigawatt scale portfolios being created with government as counterparty on one side, one or the other form of government, right? They want to do buses, they want to do solar plants. When it comes to distributed, where you have a private individual or a private or a private firm borrowing from a banker or a NBFC or a platform like yours, right? That's where the sustained demand creation and J-curve acceleration happen. Government action, the issue is J-curve doesn't happen. It's you saw that with wind. The J-curve or whatever curve was there just plummeted post the solar became the favorite, right?
Yeah.
So now it is sort of resurfacing as a hybrid, guys. But effectively, it's the distributed demand generation and debt creation for the distributed demand, which gives me the hope that we'll actually get into a J-curve from a 2030 perspective, right? Now let me go back to the point you mentioned about what about non-equivalent assets, right? So there the gap is we do not really have a project financing market in the country. From two lenses. One, from the lens of project equity. None of the equity pools coming into India, excepting a limited amount of asset owning pools from large international asset owning entities, are project equity. Most of them are venture equity, title shoppers, or dev equity, right? And title shoppers is something which we understand intimately in the Indian context, right? But venture equity is what the VCP world gives. And dev equity is what you have business houses and dev funds give, right? None of them is project equity, which is ready to wait 15 years, 20 years for project returns, nor are the taxation structures amenable to it. to give upstreaming of returns to project equity, right? So you can't create assets without project equity, right? So that's the first gap, and that hits not just climate, but it hits all kind of project financing in India, because eventually people, most businessmen become project developers or title shopping developers, etc., to get the project equity in, which has its own downsides, right? The second aspect is debt. Again, when you go to project debt, people are happy funding $100 million plus projects. They look at $20 million plus projects with some amount of favor. Anything below that, you must be posting property collateral or something like that in order for the financing to happen. And when you ask for project equity to help de-risk the asset, that is not available, right? So then the debt financier is again confused. So because there is a gap across the entire project financing ecosystem in India to fund discrete projects, right? Effectively, therefore, that whole part of financing is being created or facilitated new, which is both challenging and exciting, right? As I said earlier. But I'm going to pause, otherwise I'm going to start circling on some of the points I've said, and I think Abhishek is back.
Hey, Abhishek, sorry, we lost you there for a bit. So I'm going to, if you
The
don't
internet
mind,
connection was unstable. Sorry.
I'm going to segue from what Jayant is mentioning, right? So here is the challenge. There is a whole wide space where there are a bunch of founders who are creating new tech and a new kind of business models, and debt financiers are not really keenly looking at it right now, or particularly if I were to say, this 1 to 5 million kind of sizes, if you see, are difficult to finance. If someone is looking for debt in those spaces, particularly if they're new and entry-level tech, or maybe have some level of equity backing, or maybe don't have equity backing. So, what are you seeing these guys managing to raise debt? If yes, I also understand as a subtext to this question that there are different kinds of instruments that are in vogue, where we are talking about convertible debt, right, and warranty based debt coming into play. Are these instruments playing an active role in making that happen?
Absolutely. I think, see, convertible debt is again in two forms: optionally convertible and compulsory convertible. Compulsory convertible debt is akin to equity, so there's no difference between it. Optionally convertible debt is quasi equity, which is again in vogue. I think a lot of transactions are happening in this space on the OCPS or the OCD side, optionally convertible, securities. And there are also a large number of venture debt players who are coming in and providing mezzanine financing for more earlier stage companies with a bit of a warrant kicker, available in addition to a fixed IRR. Now, how much that is a function of negotiation. What is also very, very, so I kind of think that even earlier stage, financier companies who have not necessarily raised private equity and venture capital are also getting financing. So I have seen companies with 25, 30 crores of revenues, right, with solar assets, where they're able to get funding of 8% per annum, right, of debt. So it's not as if it doesn't happen. And the good part about this is that this is a space where if you have a project framework, right, you can actually create SPVs, which can ring fence the revenues and segregate it across various projects. So the risk to a lender is reduced, because you are then ring fencing the risk, and you're also creating escrow mechanisms by which cash flows can be trapped and structured. Now, you could have a consortium of lenders over there, or you could have a sole lender over there. If you have a consortium, you could have typically what happens in a CDO, a collateralized debt obligation, where you have a stream of cash flows and someone gets seniority over the other, and you can tranches based on the risk appetite that you have. So all of those are possibilities which are happening. And another thing that I would like to say is that the unit economics make a lot of difference, right? Because some subsectors within climate tech, clean tech are heavily dependent on subsidies. Right now, that is a regulatory risk. If you're taking a 10-year or a 15-year risk on debt risk on such a player, if the subsidy suddenly goes off, then would these things still work? Would the business model still work? That's a question which a lot of debt financiers, bear in their minds while putting this across. Again, if you look at solar, If you run it efficiently, you can get IRRs, equity IRRs in the high teens, etc. But if you look at, let's say, compressed biogas, for example, just another vertical, the IRRs over there are much, much higher, right? So it depends on a unit economics point of view as to how your cash flow is structured, how your business model is, which can really provide access to very cheap debt finance to people. I was also saying that there are specialized products available. So, for example, if you have large-scale receivables from governments or businesses or credible businesses, then you can do an invoice discounting framework. From a working capital perspective, NBFCs typically give a product wherein they try to imitate a cash credit facility which a bank gives. The holy grail is obviously to get a CC or an OD limit so that you can park excess liquidity over there and minimize your cost of funds. But because NBFCs are the primary financiers, to the earlier stage ventures that you spoke about, I think over there, what they do is that they give a series of term loans imitating how a cash credit facility would work. Obviously, that comes at a higher cost, but again, removing the tax component from it, I mean, it comes to about 10 to 12% even post-tax for high cost debt. So even that is much cheaper than the cost of equity. And then, of course, the other challenge for getting debt for the clean tech space is tenure. As my colleague from cKers was mentioning, if to get a 25-year loan or a 20-year loan is not a trivial task. It's a real it's quite difficult at times. So what people end up doing as a suboptimal option is, for example, if your solar panels are good for 25 years, they end up taking a 10-year loan, for example, and then leaving there a refinance risk refinance risk event, which will come up in the next 10 years, depending on how interest rates are at that point in time, how the liquidity situation is. This is akin to what we have seen in other capital intensive businesses, like, for example, housing finance, right? So when housing finance companies borrow from banks to on lend, typically they don't get the kind of maturities in the earlier stages till they reach a high enough rating, a credit rating, to be commanding those sort of tenures. That's where I think development funders and foreign funders are exceptionally keen on taking on this risk and increasing the tenure of funding, even if it comes at a slightly higher cost post hedging.
Thanks, Abhishek. So it's not all gloom and doom for startup
Not
founders.
at all. I think I'm quite bullish about this space. And as you said, it really depends on the sector. There's solar, there is wind, there is tidal energy, there's biogas, there is husk, there are all kinds of business models that are emerging. There are briquettes, pellets, and the beauty of this, which I really like, is that in a lot of cases, green energy sources are not only more efficient, less polluting than fossil fuels, but in many cases they're also more cost effective to the end customer. So forget the halo around impact and sustainability and all of that. It also makes hard commercial logic to switch to renewable sources of energy, which we are seeing happening.
Thank you, Abhishek.
All over. That's
a great point. I am going to come back to you guys on that. I have a question there, but before that, Simmi, I just wanted to ask you quickly that is this model of for any of these startups which have technology or a product to particularly work with, is converting that as a service? Does it make more sense, easier for them to raise finance than looking at making it a product sell or a capex based sale, capex based revenues? What I'm trying to say is I have seen in solar OpEx getting financing easily than a capex based model. So is that applicable for other technologies in the climate space, or do you think that differs from technology to technology?
Okay, so actually, I think it might be useful if I just break down, when and how you can raise your first debt, right? I think that's the question that a lot of startups come to us with.
Absolutely.
I guess whether you're doing OpEx, CapEx, product sale, service sale, I think your initial experimentation and your pilots have to be equity funded, right? Because there is, no matter which form of debt you look at, there is no pre-revenue debt in this world. for a startup, right? Which means that for debt providers to give you the first loan, they need to see that you're able to sell whatever you're selling and you're able to recover it back. So I think that's the first threshold that you have to pass. And I think once you're past that threshold, once you have your first contract, your first customers, then the question is what kind of debt is out there, right? And as Abhishek pointed out, there is bank debt, but bank debt is collateral backed. Bank debt needs 3 years of track record, profitability ratings, none of which most of our startups have, right? I'm assuming that most people in this room, as most startups who come to us, don't have collateral, don't have 3 years of track record, which means they're looking at what we call as alternative forms of debt. And you basically need debt for 2 use cases, right? One is that you need working capital. And that's the situation where you are selling a service. Let's say instead of selling your 3-wheeler, you are basically putting a fleet of 3-wheelers out in the market, and then Amazon or Big Basket are paying you every month for the service that you deliver, which makes it a working capital or supply chain loan. And that actually, depending on who you sell to, can be easy and possible to get, right? Because these are short-term debts. Short-term risk is easier for lenders to underwrite versus long-term risk, which means that all I'm taking a risk on is, will Amazon pay me next month? Yes or no, right? And based on that, the first working capital or supply chain linked loans as they can be given, right? Working capital debt also comes in another form, which is called venture debt, but that's squarely meant for VC-backed companies. Venture debt guys essentially think of it as a form of addition to equity, which means that they're giving you working capital, but that's linked not to your cash flows or revenues, but to the fact that you've raised a large equity round and they are backing on the investors' track record, capability, all of that. But that apart, this particular loan, a supply chain linked loan, to say I have received an order from Reliance to build something and Reliance is going to pay me in 3 months, is an easier credit to underwrite compared to I am going to basically build this water treatment plant that will take 15 years to generate returns, and can you fund that for a new company, right? Project finance is something that Indian banks have done traditionally a lot of, but it's always been backed by the founder's money, the founder's collateral, their house being put up as a security. So in a pure startup funding environment, young founders who are looking to basically get their first loan, I would say supply chain linked funding, services sale is easier to get. That's one part, right? But no matter what you do, you still need to fund some assets, which means that is asset funding available out there? I guess the answer is yes, but it's not ideal funding that's available. So what that means is that you can get short-term funding, like a 2 to 3 year funding, typically when you first start off, and it grows over time. So our advice to startups is to, start somewhere, right? It's not perfect, but you have to start somewhere. You have to start building a track record to say, I have taken a loan before, because a big challenge that a lot of lenders have when they give you your first loan is that you have never taken a loan before, maybe except like a education loan in college, right? So they have no way to know if you're a good payer or not. You have no stability, you have no credit rating. So even if it's an imperfect product, start somewhere, right? And you build from there.
So just to add on to what you said, Ravi, I think from a pure business point of view, giving energy as a service obviously works better, because then the capex risk is not in the hands of the end customer, right? So definitely. So I'll just give a small example. I guess most clean tech companies would be aware of it. From a solar, which is a done and dusted point of view, I have a customer who again has a customer in the C&I segment, in the cement segment, in the commercial industrial segment. Their electricity bill was 3.5 crores per month. And after they installed a rooftop solar project on them, right, the electricity bill came down despite only being able to generate about 10 hours to 12 hours per day of productive electricity, by about 50 lakhs per month. So from the end customer's point of view, from the cement factory's point of view, they were overjoyed, right? They didn't spend a rupee, and their electricity bill comes down, from over 3.5 crores, and the grid tariff is always going up, right? Whereas the solar tariffs are coming down as the panels become cheaper. So obviously, energy as a service makes far more business sense. But the point is, do you have the balance sheet to actually build those assets onto your business? Because you will end up owning them and operating them, and then collecting from the client on an as-go basis. Now, if you're doing that, let's say a solar project today per megawatt, you would spend about 3 crores roughly, give or take, right? So on the 3 crores, the highest leverage that at least we have seen is about 30-70, right? Where 30% of it would be funded by equity and 70% would be funded by debt. We haven't, in very rare cases, these very credible companies, you can go higher, but that's an aggressive target to take. So you would require out of 3 crores, at least 1 crore of equity. So if you are putting up, let's say 10 megawatts, right? You would need 30 crores, and you would need on that, you would need about 10 crores of equity to start off with. So you must have that kind of pockets to be able to give energy as a service to your clients. But again, if you can do that, that's a brilliant model to build, because that builds annuity income. If you're doing an EPC business, it's like running on a treadmill, right? The day you stop generating leads and sales, you collapse. But if you have a built-in energy as a service business, even if you stop doing business development for a year, 2 years, your annuity income still comes flowing through. So the kind of valuations that you get over time because of the locked-in value are also much better in energy as a service business. But you need to have the capital to start off with.
Thanks, Abhishek. I know all about the treadmill that you're talking about. I keep running on it. Thanks so much, Simmi. I think you have answered a lot of questions in that particular question. You have told us when should a founder look for money, when should a founder look for focus on debt, and what kind of debt is easier to access, and whether asset-backed debt is available or not. I think that's 3 questions in one. Thanks so much, Jayant. So here is a question for you, right? So Simmi passing mentioned, of course, you did mention too that project finance is a bit of a challenge outside of the traditional businesses, or businesses which have already seen a certain level of I would say like energy or transportation, which have already seen some level of transition. Technology is accepted already, and they understand the risks and the models better, right? Like Simmi rightly pointed, at one point they were also not underwritten by the banks, but over a period of time they have changed their minds thanks to whatever impetus that has gone into it. But is banks totally ruled out for startups, or do you still see that banks, like say for working capital access or for let's say short-term capital needs or revenue-based financing needs, should they go to a bank?
Thanks for that, Ravi. So again, idea was not to spread gloom and doom. The idea was just to say, given the scale of capital you talked about, where is the money coming from? We have several times being the first lender. In several times, a bank has been the first lender in clients we have lent to, right? What Simmi was coloring was, you need to figure out the banker you're going to, which product they are ready to fit you into, right? It could be simply an FTOD. It could be a bill discounting limit. It could be a small cash credit. CGT-MSE has increased limits to 5 CR. So that has indeed become a tangible option, and banks are far more open to doing CGT-MSE limits now than they were 10 years back, right? But linking into the point which Abhishek mentioned and I had mentioned earlier, right? If you do not have equity, you will not get project finance. If you have equity, even then it's not necessarily linking to the point Simmi mentioned, whether you get something which is collateral free or which is appropriate duration. So given that the banking system usually gives money at a lower cost, but not necessarily at the better terms in terms of other than cost compared to any other lender, each organization typically desires to put a transition pathway to going to bank debt, right? Now, whether you get something on day one, you've started a relationship, doesn't mean you can expand. We have had situations where clients have struggled to scale the initial banking limit of 1 crore, 2 crore. And they have had NBFC lenders who are giving 15, 20 crores. And the banker is not playing ball in terms of helping in any way, in terms of facilitating debt access from their side or from the NBFC side. So it is so, especially the public sector bank system, which so branch manager orientation dependent, that it becomes a bit troublesome. Having said that, people have raised funding. Nobody stops, no finance team stops trying to raise money, right, of various types and size is. What we are looking at, if you're trying to solve systemic, is different from what we are looking to try and solve specific, right? Specific, you will obviously encourage person to go and try 6, 5, 6, 7 means, depending on what bandwidth they can bring to bear, right? And where they are in their journey. And that's where Simmi's advice is spot on. But if you're trying to solve for the systemic, Abhishek talked about equity, and that's what I had talked about, Abhishek, as well. There is no project equity in the market. You don't really have any investor giving you money to be paid off in annuity payoffs over 20 years. There is not there. Now, if you don't have, so you basically are running a refi treadmill on the equity. And equity doesn't refi easily, right? Because you have to do secondary rounds and IPOs and stuff like that. Or you're running the SPV treadmill, SPV structures on SPV on project finance, where you're making a series of SPVs, and as you keep refinancing them as assets get proven and keep reducing the equity. But all of this is trying to solve for lack of project equity. And similarly on project debt, what you're trying to solve for is not lack of project equity alone. People do something or the other to bring that in. But you're trying to solve for, what if my projects are in the 1 million to 5 million range, which Abhishek covered, right? How do I get a lender which typically wants to do 20 million plus projects to get interested in that? Because as of this point of time, project finance mostly is sub-economic for most lenders. Most lenders don't make a load of money on project finance. They make a load of money on personal finance. They don't make a load of money on project finance, right? So therefore, they are trying to solve for that, making sure they're doing a limited number of larger projects. And therefore, they can make return on time invested. Just pausing there. Not sure whether I colored what you wanted me to cover, but.
Yes, Jayant. Yeah, please, Simmi, you had something.
No, I was just going to say that I've been doing this for 12 years now, and while a lot of challenges exist, the good thing is that we have really seen the universe of lenders expand in the last 3 years, right? We've seen guys who have never thought of climate as a capital allocation 5 years ago now putting significant dollars behind capital. And that's all the DFIs in the world. That's a lot of domestic lenders. That's a lot of new platforms that have come up. So while it's not perfect, additional capital is becoming available. So that's one good thing. The other point I would like to make to this whole discussion we're having around, like the lenders find it easier to fund 20 million plus projects. We have gone out and actually, had instances where lenders have agreed to do smaller projects, like large lenders, right? And in fact, we are structuring what I believe right now is probably India's first carbon-backed loan, for example, with a DFI, right? And I think it goes to both sides. Yes, lenders need to be sensitized to how to lend to these smaller projects, but also a small company borrowing from a large lender equally needs that company prepared on so many different levels that they're just not ready, right? Which means that skills and capacities need to be created on both sides, just as lenders and investors need to emerge to lend to these, what we call the missing middle, right? You can get a 1 crore loan, you can get a 20 million loan, but nobody does a 1 to 20 essentially, or very few people do 1 to 20. So just as new lenders need to emerge to bridge that gap, I think a lot of capacity building needs to happen on the startup side as well, because just the number of things they need to be prepared for when they go through diligence is not like easy, essentially.
So I'd just like to add on over there, again, the kind of capital that you get, right, is dependent on the product. More than the stage of the company is dependent on the product. Even an early stage company, which is looking to set up, let's say, a plant, right, and has the, the requisite 30%, 40% equity to do so, is able to get financing at really low rates, because again, you have assets which are being created out of it. But if you're looking at a pure cash flow based inventory, finance or a working capital, right? So unless what Jayant mentioned, you have an FDOD, which is a senseless facility because you're pledging an FD and then you are leveraging of it. So that's really is not giving you leverage per se. But if you're doing a clean cash flow based OD, then obviously you need the company to be slightly more mature in terms of business experience. So it really depends on the product, what you're targeting, whether you can get financing from Indian banks and at low rates. So, and the SPV structure really helps. One other thing that I'd like to point out is that we are even seeing equity coming in at the SPV level, right, with some clients of ours. So, if you're doing a plant in, say, for example, a Guntur, right, in Andhra Pradesh, and you need, let's say, 20 crores for that plant. You can form an SPV. You can have a situation where you create an equity component of that going out, typically to family offices, etc., who would come into this opportunity, and then lend on a structured basis where they would take a fixed payout, and then they would have a slice of equity as well on the project. And so that market is nascent, but it is changing. So you will see, as the market matures, more hybrid lenders coming in, and I believe more rupee capital coming in, where led by the family offices, and hopefully the banks would follow later. You will find this hybrid component coming in, where project level financing gets financed.
Thank you, Abhishek. Thank you so much, Simmi. Thank you so much, Jayant. I would like to go on. I still have a couple more questions, but I think I've already overshot my time limit. So on that note, I would like to open the forum for questions. Any of the